Look at your screens. What you are witnessing right now is not a standard market correction. It is a violent, systemic decoupling. It is a decoupling that defies every traditional textbook rule of finance. For decades, we were told that when the world catches fire, you hide in the safety of precious metals. But as the sirens wail in the Middle East and global supply chains fracture, the unthinkable has happened. Gold just suffered its sharpest, most aggressive reversal in recorded history. After touching a staggering peak of nearly $5,600 per ounce, the floor gave way. Silver, the volatile devil's metal, was the darling of the retail squeeze, surging past $120, before being hit by a gut-wrenching 40% drawdown, crashing back to the $70 range in a matter of days. Investors who thought they were hedged are now staring at deep crimson portfolios. But here is the anomaly. While the supposed inflation hedges are cratering, the actual cost of living is exploding. Crude oil has gone parabolic, screaming to $170 per barrel. This is the great rupture. The correlation between hard assets has snapped, and it has left the average investor blinded by the dust of a collapsing bull run. This was not a random event. This was a systemic liquidity rupture sparked by a triple threat: the escalation of the Middle East war, a brutal hawkish pivot by a trapped Federal Reserve, and a terrifying liquidity cliff involving the April 1st banking deadline. To understand why gold plummeted while oil soared, we have to look at the changing of the guard in Washington. The sudden nomination of Kevin Warsh to lead the Federal Reserve sent a lightning bolt through the bond market. For years, the debasement trade relied on a central bank that would always blink, always print, and always protect the stock market. But Warsh represents the return of the monetary hawk. His reputation for fierce central bank independence signaled to every major institution that the era of easy money is not just over, it is being dismantled. The reaction was instantaneous. The United States Dollar Index, or DXY, spiked to levels we haven't seen in years, while Treasury yields went on a vertical tear. This created a massive headwind for precious metals. You see, gold pays no interest. When the yield on the 10-year Treasury note screams higher, the opportunity cost of holding gold becomes too high for institutional desks. For the first time in 18 months, real yields, that is, the interest you earn minus inflation, turned positive. The smart money didn't just walk away from gold, they ran toward the safety of King Dollar. But here is where the story gets dark. The Federal Reserve is now caught in the ultimate Fed trap. On one side, you have crude oil at $170 per barrel. This is a massive regressive tax on every single consumer, all in the global economy. It drives shipping costs higher, makes food more expensive, and guarantees that inflation will remain sticky and elevated. If the Fed hikes interest rates to combat this energy-driven inflation, they risk a total collapse of the commercial real estate market and a cascade of regional bank failures. However, if they pause or pivot to save the banks, they risk a total currency meltdown as the dollar loses its purchasing power against a barrel of oil. This is a no-win scenario. The market realized that the Fed can no longer subsidize the gold rally while trying to keep the banking system on life support. This realization triggered a massive rotation. Investors sold their paper gold and paper silver to raise cash, bracing for a period of extreme volatility where liquidity is the only thing that matters. This wasn't just a change in sentiment, it was a fundamental shift in the plumbing of the global financial system. The Fed is no longer your friend, and the Warsh shock proved that the safety net has been pulled back. As the dollar strengthened, the foundation of the gold bull market began to crack, leading us directly into the energy crisis that changed everything. While the precious metals market was reeling from the Warsh shock, the energy sector was dealing with a literal explosion. The coordinated airstrikes on February 28th marked a point of no return. As missiles fell, the geopolitical risk premium shattered to the upside. Brent crude didn't just climb, it went vertical, blowing past $100, then $140, and finally settling near $170. Roughly 20 million barrels of oil moved through the Strait of Hormuz every day. That is 20% of the world's liquid consumption. Today, those flows have slowed to a trickle. Tankers are sitting idle or taking the long route around the Cape of Good Hope. We are no longer just paying for the oil. We are paying a massive security and logistics tax passed directly to the consumer. Now, here is the advanced question. Why did gold crash if oil rose? The answer lies in the hidden plumbing known as margin contagion. Modern hedge funds do not trade these assets in isolation. They use massive leverage to bet on everything at once. When the conflict began, dozens of major funds were caught short on oil. As oil screamed to 170, they lost billions. To stay solvent, these funds received massive margin calls. They didn't have cash to cover losses, so they sold their winners to raise capital. Their biggest winner of 2025 and early 26, gold and silver. This was a liquidation event where fundamental value didn't matter. It was a classic selling the house to save the car scenario. Oil has temporarily replaced gold as the dominant safe haven asset. We are now approaching the most critical date, April 1st. The real black swan is a massive regulatory shift deep within banking plumbing. This is the implementation of the Basel III endgame, and it is the primary reason the gold markets experience systemic cardiac arrest. For years, bullion banks have used unallocated or paper gold to suppress price. But as of April 1st, the rules are being rewritten. Under the new net stable funding ratio, gold and silver are being reclassified. Physical, allocated metal is now a Tier 1 asset. This means it carries a 0% risk weight, making it as good as cash or sovereign debt on a bank's balance sheet. However, unallocated gold, the paper contracts, now carries a staggering 85% required stable funding penalty. Leading up to this deadline, bullion banks like JP Morgan and HSBC have been frantically trying to clean up their books. They cannot afford massive unallocated short positions past April 1st. This is why we saw the bid side of the market completely vanish. The banks aren't just selling gold, they are withdrawing from the paper markets to avoid regulatory insolvency and moving into physical allocated markets. Silver is in an even tighter spot. Its Tier 1 status is complex because silver is an essential industrial metal. Banks realize the physical silver shortage, driven by solar and AI infrastructure, makes it impossible to back their paper liabilities. The New York Fed is currently pumping $40 billion a month into repo markets just to prevent the pipes from seizing up. They are trying to engineer a soft landing, but the $170 oil shock has made that almost impossible. As we count down the final days to April 1st, volatility will intensify. The paper market is dying, and the physical market is taking its place. While the fundamental and regulatory shifts are the why behind this crash, the how was purely mechanical. We have to talk about the pipes. On March 12th, the CME Group, the world's largest derivatives exchange, quietly raised the maintenance margins for silver contracts by 25%. In an instant, every trader holding a position was forced to either deposit thousands of dollars in extra cash per contract or liquidate immediately. This wasn't a choice. It was an automated execution that hit the market like a tidal wave. Currently, traders must put up nearly 18% cash just to hold a silver position. This is a massive deleveraging event. But the real chaos came from cross-collateralization. In the modern era of 2026, the inflation trade is a giant interconnected web. Major hedge funds no longer just hold gold, they hold digital gold. Bitcoin and Ethereum are now staples in the same portfolio margin accounts. When Bitcoin faced a sharp correction, dropping from its peak of $88,000 down toward $85,000, it triggered a domino effect across all risk assets. The algorithms don't care about your thesis on the Federal Reserve. When a fund's crypto position loses 10% of its value, the prime broker's software automatically looks for the most liquid asset. That asset is almost always gold or silver. This is why we saw gold dumping at 3 o'clock in the morning Eastern Time. The gold market became the ATM for the failing crypto and oil short positions. This mechanical failure was amplified by high-frequency trading bots that are programmed to sell when certain technical levels are breached. And once gold broke the $5,000 psychological barrier, the floodgates opened. This wasn't humans deciding to sell. This was machines executing a pre-programmed exit strategy. Understanding this is vital because it proves the crash was driven by a lack of liquidity, not a change in long-term value. So, where does this leave us? Is the bull run over? Or are we witnessing the most sophisticated bear trap in market history? To find the answer, stop looking at the flashing red numbers and start looking at what the big money is doing. While retail investors were panic selling their silver at $70, central banks were doing the exact opposite. Last year, global central banks swallowed a record 800 tons of gold. They are moving into a post-dollar reality where physical collateral is the only thing that guarantees sovereignty. This crash was a gift for them, a massive liquidity event that allowed them to buy the dip while the paper market burned. The great reset of the banking system is happening right now, and the April 1st deadline is the finish line. If silver can hold $70 and gold stays above $4,500 through this month, the technical cup and handle remains intact. We are likely looking at a spring-loaded move towards $6,000 once the Basel III regulations lock in. Don't let the mechanical noise of a $170 oil spike shake you out of a generational trade. The trap is set, the deadline is coming, and the real move hasn't even started yet. Want more? Share, and hit subscribe for daily updates.